Thanks a lot to all of you for this event where we will hear the presentation by the IEA about gas 2021, a report that has just been published this morning, which discusses the recent trends in global gas markets and also takes a look at medium-term trends and developments until 2024. This has become a regular appointment, a quarterly appointment with Kobi van der Linde, director of the Clean Energy International Energy Program, Jean-Baptiste, senior gas analyst at the IEA, and Gergely Molnar, gas analyst at the IEA. I am Luca Franza, scientific advisor to the Energy, Climate and Resources Program at Istituto Affari Internazionali, IAI. These last few weeks and months have been very interesting for gas markets. We have seen extremely high prices in Asia, first of all, but also in Europe. So we've witnessed to the ability of Asian prices to drag TTF with them. After all, we are in globalized markets, so it is it makes sense that gas prices show some convergence and move in sync. I think what we have now is a situation where net importers are in one price region, notably Asia and Europe, and net exporters are still in another price region. We will hear from the IEA what the numbers are and precise figures and data both on recent weeks and months and about the outlook. But I would just like to share some introductory remarks on my end. I think we reached a point where it's possible to start drawing some conclusions in hindsight. Because for many years we have been told that an oversupply and a glut were looming over the world and over Europe with regard to natural gas market. But actually this long-awaited and much foreseen oversupply has not been seen at play that much in the last 5 to 7 years. Every time there seemed to be a bit of an exception to the foreseen rule, a contingent factor that postponed always by a little bit the arrival of oversupply and low prices. And then it happened again and again. First, it was niche markets that outperformed and absorbed a lot of flexible LNG. Then it was China that imported more flexible LNG than had been foreseen. Then it was because of some delayed startup on liquefaction, then because of maintenance, perhaps strategic maintenance sometimes, shutdown to liquefaction capacity in the US, and then also, of course, cold spells and weather factors playing a role. So yeah, it's possible that these have been exceptions and contingent factors. But then in the end, in the last 5 to 7 years, we've seen these exceptions at play really a lot. So there have been many factors that in the last years have smoothened, delayed, and in a certain way, I think, eliminated the effects of the wave of FIDs that had taken place in the mid-2010s and that we thought would provoke a situation of very abundant supply and very low prices for a long time. It's true that some very low prices have been seen, of course, in 2020 due to COVID-19, but honestly also in a number of months of 2019 when COVID was a factor. But for a number of months now, gas prices are particularly high, and not only, as I said earlier, in premium markets, but also in Europe. We are seeing, TTF prices above $10 per MMBTU. And I think a very interesting factor, a very interesting phenomenon that we see in the current conjuncture is that flexible volumes of GNL are, of course, of LNG are absorbed by Asia. And we also see dynamics whereby some suppliers are sticking to annual contracted quantities when they supply to Europe. Even if they would be in a position of selling more, perhaps to support prices also in Europe. So perhaps some suppliers are not simple price takers, as had been said for a long time. And so perhaps as analysts, we could draw the conclusion that the current situation gives us a bit of a tasting of how the EU is not totally shielded from the risk of high prices, and also the exertion of value over volume strategies by suppliers. And it's legitimate, I think, to raise the question as to whether the current dominant paradigm on security of supply in Europe is always valid. You know, that we don't need investments on a new gas infrastructure or capacity or long-term contracts, because basically we have these waves of FIDs and oversupply, and you know, it's just enough to have some underutilized regasification capacity in our terminals to have access on demand to flexible volumes of LNG. These both, I think, involves security of supply and affordability considerations, because actually affordability is starting to become a problem for gas users. In Europe at the moment, industry has to deal with very high import gas prices and also high CO2 prices. So it's asking for some reassurances. Of course, there could be the counter argument that this is just a temporary phenomenon that we see at play, and that many things will just be fixed, will fix by themselves. There will be a lot of gas around because the latest wave of FIDs just at the end of the 2010s, also in 2019, has not yet translated into volumes that are available. These will become available going towards 2025. And so this is just a bit of a temporary situation. I'm just saying that this had already been foreseen for the period 2015 and 2020. And then, as I said, we didn't always have this abundant supply. And also, perhaps we could start wondering if some trends that are always described as contingent and temporary might become structural, even weather patterns, you know, extreme weather phenomena. Yeah, of course, they're unforeseeable and contingent, but we see them recurring more and more often. And I think what we have seen in Canada and the Western US is also a proof of that. And so we might have to have more and more strategies in place to be resilient against these recurring extreme weather events. And also some behaviors by Asian buyers, the ability by a lot of Asian buyers to stockpile gas volumes in advance. This is perhaps something slightly new, because before they didn't have the storage capacity to do that. And so to stockpile volumes, and that has, of course, an effect on the availability of flex LNG. But this is just enough from my side. I just wanted to give a bit of a perspective also on the last couple of years, and draw some conclusions, as I said, in hindsight. I've taken a look at the report that the IEA published this morning, and there are really juicy analysis on gas demand for hydrogen production, methane leakage, net zero. So I'm really looking forward to a very interesting webinar. And I would really like to thank all the participants, and I would now like to give the floor to the IEA for their presentation, and their presentation will be followed by moderation by Kobe van der Linde, and then a Q&A session. Thanks a lot to everyone.
Thank you very much, Luca, for your kind words of introduction. Good morning, ladies and gentlemen. My name is Jean-Baptiste. I'm Senior Gas Analyst at the IEA, and with my colleague, Gergely Molnar. It's our pleasure this morning to be again with you to share the main findings from my latest natural gas market report. I'd like to take this opportunity to thank our good friends from Istituto Affari Internazionali and Klingendale International Energy Program for hosting us again for this presentation. So without further ado, let me switch to the presentation itself. As you will see, if when you'll be able to download the report from our website, the this report has been this medium-term report has now been switched to a 3-year perspective from the usual 5-year perspective that we used to provide, given the uncertainty that concerned the pace of recovery from the pandemic and also the level of the policy intervention to accelerate the clean energy transition around the world. We have decided at the IEA to shorten the projection period to the next 3 years to give stronger focus on tracking the short-term trajectories of natural gas consumption and supply. So to begin with the very short-term context, and to echo what Luca was saying in his introductory remarks, well, if you have been attending the presentation we made 3 months ago, saying that we just gone out of winter and the spikes that we have seen were just momentarily. Our belief was that the rest of the year would be a rather calm year. This is a good illustration that how tricky the business of a forecaster can be. As you can see on this on the chart, the price trend has not been that calm over the past months. This results from a combination of both economic-driven, weather-related, and supply-demand factors. As Luca illustrated, we've had a string of extreme events with droughts in Latin America, heat waves in Asia, and in the Pacific coast of North America. At the same time, the LNG market is more than tight, with unexpected maintenance and outages in several liquefaction plants. And on top of that, the spring has been colder than expected in Europe. So if you pile up all those elements, end up with the market situation as we see it today. The rebound has been very, very strong compared to what we have seen less than a year ago. So how do we see the remainder of the year? Just as a quick reminder of previous episodes, last year, 2020, energy demand fell by 4%, which is in absolute term the largest ever absolute decline and the largest ever seen in the past century or so. Natural gas, of course, like other energy sources, was negatively impacted by the economic downturn, which came on top of one of the mildest winter ever recorded in the Northern Hemisphere. Gas demand, however, remained resilient, with our estimate is 1.9% year-on-year decline for last year, about 75 billion cubic meters of demand reduction compared to 2019. The vast majority of this decline, as you can see on the chart with the gray bars, took place in the mature markets across North America, Eurasia, Europe, and OECD Asia, whereas the more dynamic markets in the Middle East or non-OECD Asia experienced limited but positive demand growth in 2020. We do expect this year to see a quick rebound in gas demand, which will offset last year's losses and even create additional growth, with an expected 3.6% annual increase in gas consumption. This is, as I said earlier, driven by the economic recovery, which supports industrial sector gas consumption, with the industry being the largest contributor to growth. It is also driven by weather-related condition, with what we've seen in the past winter, and also the current drought and heat waves episodes that we currently experience in different regions of the world. As you can see on the chart, gas demand grows in all regions this year, but all regions are not equal in terms of recovery. In the fast-growing markets in Asia, Africa, the Middle East, demand growth is sufficient to go beyond just offsetting 2020 losses, and is likely to create some net increase compared to pre-COVID situation. Eurasia and Europe also seeing positive growth thanks to the strong contribution of cold temperatures that we've seen in the past months. On the other side, in North and South America, where power generation is the main demand driver, see that higher gas prices is likely to hamper the recovery this year, and the gains from 21 may not be enough to offset the losses from 2020. If we look a bit beyond this year and our view to the next 3 years, we do expect natural gas demand to reach close to 4,300 BCM by the end of our forecast in 2024, adding some 350 BCM or about 9% compared to 2020. If you look at the pie charts on your left, you see that the largest chunk of this recovery is likely to happen this year, with about 40% of the increase for the forecast period taking place in 2021, with a 3.6% increase rate, and then declining progressively over the following years to 1.7 at the end of the forecast in 24. If we compare to pre-COVID situation in 2019, the growth is about 7% by 2024, or an increase of 275 billion cubic meters. In terms of sectoral contributions, with the middle pie chart, you see that the industrial sector, which is, again, the main driver behind recovery this year, also keeps going in the next years as the leading player. Growing demand for natural gas is both for industrial processes and also as feedstock, expected to account for a dominant 40% share of the total increase in gas consumption for the 2020 to 24 period. Last, on the right-hand side, you see the regional contribution. It's again the Asia-Pacific region, which accounts almost for half of this contribution. The second largest contributor, the Middle East, is less than 20%. And for most of other regions, especially for the most mature markets, the bulk of the increase is tied to the recovery that we are expecting to see in the coming months from the 2020 downturn. Another interesting way of seeing this increase is how we can split it into the different drivers that contribute to gas demand growth. This is the exercise that we have carried in this report. Again, different factors at play. The role of gas is quite complex depending on the level of maturity of the different markets. And in between 2020 and 24, we do expect that substitution of gas with other fuels such as renewables and efficiency gains reduce natural gas demand by about 80 BCM, mostly in power generation, which moderates an initial gross demand increase of 430 BCM to a net increase of 350 BCM over the forecast period. As mentioned previously, as you can see on the chart, the short-term recovery plays a major role in this forecast, and the demand gains expected for 21, accounting for about 40% of the total increase in the next 3 years. The vast majority of this increase in 21 is linked to economic recovery as the markets recover from the impacts of the lockdowns of last year and the activity slowdown. Following years 22 to 24, global gas demand growth is driven in equal proportion by economic activity and fuel substitution. So on the one hand, you have high economic activity, especially in emerging markets. It's primarily driven by industrial output, which in turn results in growing gas consumption for power generation and industrial sectors. Those two sectors account for roughly 70% of gas demand growth driven by economic activity after 21, and take place, as you may expect, in the faster growing markets, especially in Asia, but also in Africa, the Middle East, and South America. On the other hand, the fuel switching, which does not add to the energy consumption and emission, but comes at the expense of other more CO2 emitting fossil fuels accounts for the other half of this growth. And in this situation, power generation again takes the lion's share. It's about 50%, but other sectors also at play. If we look at the main drivers in terms of regions, it is fuel substitution in Asia and in the Middle East, which account for 2/3 of this overall potential. The Asian story is mainly led by China, and it targets coal mainly both in industrial and residential sectors, with the rollout of the government plans of conversion of coal to gas boilers in those sectors. Whereas in the Middle East, the substitution gains are most entirely driven by the power generation sector and mainly at the expense of oil. So this is a bit more detailed. Again, 50-50. As I said earlier, see that the power generation is taking a strong share, but it's not all about power generation. I mentioned industry. There's another important driver, which is the transport sector, which accounts for about 15-20%, essentially taking away from oil. See that half of it comes from Asia. There's also a sizable chunk coming from the Middle East. Of course, there's almost no coal in the Middle East, so all of the substitution is coming from oil, principally in power generation. And the indicative breakdown, it's about 2/3 coming from coal, a bit more than that, and some coming from oil in the different sectors, ranging from power generation, industry, and transportation mainly. The global increase in gas demand for the forecast period is rather modest. We expect a compound average annual growth rate of 2.2% for 20 to 24, which is compared to 2.6% for the past years, 15 to 2019. But in spite of this lower rate, this may, however, be already too high in order to meet the longer-term climate objectives, and in particular, net zero emission target by 2050. You have on this chart, we have plotted some figures from the IEA's latest scenarios. So the red dots show the IEA's sustainable development scenario, which maps out a trajectory consistent with global net zero emission by 2070. And in this scenario, gas demand increased by only 4% in between 2020 and 25. So the output of our forecast to 24 is already 2% above that SDS scenario level by 25, and 7% above the SDS by 2030. And the inflection is of course stronger if we compare it to our most recent net zero by 2050 scenario, and our 24 forecast level stands almost 15% above that 2030 level. The gas demand trajectory should therefore flatten in the next years to keep on track towards global net zero emissions by 2050. However, this is not a simple story of just reducing gas consumption in every places, because as you've seen in the previous slide, part of this gas increase provided a positive contribution to lowering global emission through the substitution of fuels, while the economic activity-driven growth in gas demand results principally from the expansion of fast-growing markets and improved access to energy. So the remaining drivers to slow demand growth would then be to further accelerate fuel switching from gas to low-carbon fuels and, of course, make more efficiency gains. To that purpose, stronger policy need to be introduced in our forecast period to underpin further fuel substitution and efficiency gain, and this is especially the case in the more mature markets where much of the coal to gas and oil to gas switching potential has already been tapped. So with that, I'd like to pass the mic to my colleague Gerge, who will guide you through the supply story which is behind our forecast.
Many thanks, Jean-Baptiste. My name is Gergely Molnár. I'm a gas analyst at the International Energy Agency, and please allow me to join Jean-Baptiste in thanking our host, Kobe and Luca, for having us today. It is really a pleasure to be here at our traditional gas webinar. When looking at the supply side, the massive amounts of investments made before the COVID-19 crisis will be progressively converted into production capacity in the coming years. The bulk of additional capacity comes from three regions mainly: Eurasia, the Middle East, and North America. In Eurasia, this will be largely driven by the development of giant Russian fields, both in eastern and western Siberia, targeting primarily at pipeline and LNG export markets. In the Middle East, growth is related to the commissioning of a limited number of large-scale projects already under development, aimed both at domestic and export markets. Over half of the region's development comes from the giant North Field and South Pass to meet Qatar's and Iran's new production needs. This is complemented by additional developments in Saudi Arabia and Israel. In North America, additional supply is almost exclusively coming from US shale basins, largely driven by export markets as LNG export capacity keeps growing with the commissioning of projects currently under development. As US LNG projects are usually not integrated with upstream resources, the commissioning of new LNG export capacity will require new gas production to be developed in the next years. And if you move to the next slide, please, we will see that LNG trade is set to remain a key driver of global gas trade. LNG recovered strongly from its loose market situation of mid-2020s when it played an important role in adjusting supply to the sudden drop in gas demand. The combination of recovering demand, sporadic cold spells, and unexpected outages at liquefaction plants all contributed to a retightening of the market and pushed up prices. This also translated into lower LNG flows to Europe, which compensated with pipeline imports and storage withdrawals. LNG grew by 5% year-on-year in the first half of 2021 and is expected to increase by 4% for the whole year. When looking at the medium term, global LNG trade is expected to grow at an annual average rate of 3.3% to 2024, much slower than the double-digit increases observed between 2016 and 19. The wave of LNG FIDs taken before 2020 should suffice to satisfy additional LNG demand in the coming years. The global liquefaction utilization rate is expected to return progressively to its pre-2020 levels by 2024. And in the absence of major project delays or unplanned outages, the risk of a structurally tight market appears limited before 2024, with the possible exception of short seasonal episodes, as we have seen recently. And further flexibility would help to ensure security of supply in an increasingly interdependent global gas market. Destination-free US LNG is contributing to this, with US projects accounting for the majority of incremental LNG supply capacity to be commissioned in the coming 3 years. And if we move to the next slide, thank you, we see that the nature of gas supply is also evolving. Low carbon gases, including biomethane, low carbon hydrogen, and synthetic methane, can play a key role in reducing the emission intensity of gas supply and support the decarbonization of the broader energy system. While their production remains expensive and their large-scale deployment will take time, recent market developments provide grounds for optimism already in the short in the medium term. In contrast with natural gas, biomethane production continued to grow strongly in 2020. Preliminary data suggests that it expanded by 18% last year to reach close to 5 BCM, a tenfold increase since 2010. And biomethane production is expected to double in the next 3 years, while the red set of policies could provide additional upside potential for biomethane development, especially in the rapidly growing markets of the Asia-Pacific region. Blending hydrogen in gas networks can provide a transitional solution until a dedicated hydrogen network is developed. Several pilot blending projects have been undertaken in recent years, both at transmission and distribution system levels, with promising results. Based on projects that have reached FID or are under construction, hydrogen blending capacity could increase by more than tenfold by 2024, largely driven by Europe. In contrast with hydrogen, synthetic methane is sort of struggling to take off. While it is perfectly interchangeable with natural gas, its production requires the development of a separate carbon value chain. Only a few projects are currently under development, indicating a potential stagnation in synthetic methane production in the medium term. Still, it could play an important role in providing system flexibility and coupling methane and hydrogen networks in the future. If we move to the next slide, we see that carbon management solutions such as CCS or CCUS can significantly reduce the emissions from conventional hydrogen production, including from steam methane reforming. Fossil fuel-based hydrogen currently accounts for over 98% of global hydrogen production, resulting in over 900 million tons of CO2 emissions per year globally, of which about 70 to 100 million tons are in the European Union. The first commercial scale SMR facility equipped with CCS technology started operations back in 2013 in Texas. However, progress on new SMR plus CCUS projects development has been meager since 2016 due to a combination of poor project economics and often challenging regulatory environments. The recent surge in European carbon prices is rapidly improving the cost competitive position of low carbon hydrogen produced via SMR plus CCS. EU ETS prices rose from an average of €12 per ton during the last decade to a carbon price of over €55 these days. Consequently, the cost differential between SMR and SMR plus CCS decreased significantly in recent years. This in turn could support additional investment in CCS-equipped SMR projects in the medium term and reducing the emission intensity of hydrogen supply. And if we move to the next slide, please, we will see that we have also a lot of homework to do when it comes to addressing the emissions along the LNG value chain. Global LNG trade has more than tripled since the beginning of the century, while GHG emissions from LNG supply and end use had reached an estimated 1.25 gigatons of CO2 equivalent by 2020, about 17% of total emissions associated with natural gas. And reducing emissions will require efforts through the entire value chain. Focus should be given on minimizing venting and leaks, deploying carbon management solutions, improve efficiency rates, and sourcing low carbon electricity to power production and processing facilities. Besides reducing emissions through the supply chain, it is important to highlight that the majority of emissions stem from the end-use combustion of regasified LNG, typically 60 to 80% of total emissions. Improving the efficiency of the power fleet and CCS, CCUS-based solutions can reduce end-use emissions. As such, reducing emissions from LNG will require efforts both from suppliers and consumers and should enhance their cooperation in that space, both at the technology level and the development of an effective measurement, verification, and reporting framework. Carbon or GHG offset LNG continues to gain traction. Under this mechanism, stakeholders involved in LNG trading can agree to buy carbon credits to offset carbon or GHG emissions from the LNG value chain. Since July 2019, at least 16 carbon offset LNG cargoes have been delivered, of which at least 2 Asian buyers. The scope of emissions typically covers all the segments of the value chain, including combustion, while a few cargoes have been delivered with partial emission offsets. And in more recent deals, emissions have been expressed in CO2 equivalent, while others explicitly indicated the inclusion of methane emissions. Expectation of tightening future regulations and emission standards are set to drive investments in GHG emissions reductions measures over the medium term. Meanwhile, emission intensity is emerging as a critical differentiator among LNG products, as lower emission profiles are seen as a natural hedge against regulatory uncertainties. And now I would like to give back the floor to Jean-Baptiste for the concluding remarks. Thank you.
Thank you. So to wrap up on the key takeaways from this latest report, we do expect gas demand recovering this year from its 2020 decline and to increase by about 3.6%. Growth will slow down in the next 3 years, 22 to 24, driven by fast-growing markets, by switching from coal and oil in power generation and other end uses. In spite of this slower gas demand growth, more switching from gas to low-carbon fuels and efficiency gains should be supported by policy frameworks in order to get on track to net zero emissions trajectory, especially in the more mature markets where much of the coal to gas and oil to gas switching potential has already been tapped. Natural gas supply growth in the coming years will be principally delivered by projects under development, resulting from the massive wave of investment that was enacted before the COVID-19 crisis. But the gas industry needs to further focus on improving its footprint by reducing methane emissions, developing carbon management solutions along the value chain, and increasing low-carbon gas supply sourcing. International trade, and in particular LNG trade, is returning to growth, although at lower rates than in the pre-COVID period. Adequate capacity must be maintained to provide flexibility to the system and ensure continuous security of supply to accompany the transition to clean energy systems. Thank you very much for your attention.
Thank you very much, Jean-Baptiste and Gergely, for this presentation. We already have some very interesting questions for you in the chat. I'm not sure you can see them, so I will read them out for you. What is the driver behind the increase of gas consumption at European power sectors, despite the higher gas prices? That would be the first question. I don't know which one of you would like to take that one. I guess, Jean-Baptiste, you did demand.
I'm happy to take a first stab at it, but Gergely, please go ahead if if I'm missing anything. Well, the situation of the power markets in Europe is quite specific if we compare it with other other market-driven, competitive-driven markets, such as the United States, for instance. In the main difference is the presence of the ETS scheme. When you look at the US situation last year in power generation, we had a strong swing in favor of natural gas because of the very cheap level of prices. And then what we see since, I think, December last year is a strong swing back of coal on the back of cheaper coal prices. In Europe, the presence of very high CO2 prices somehow sheltered natural gas from this swing that we have seen in the US. Although, of course, there is also an increase in coal-fired generation compared to last year because of the global increase in electricity demand in Europe. That's the first thing. The second thing, of course, is that we have seen colder than average temperatures since the beginning of the year, and also a colder spring, which has increased power generation needs throughout Europe. Okay, I don't know if you want to add anything to this.
Thank you, Jean-Baptiste. I think that's an excellent overview of the market dynamics. Maybe just to add one point is that the major driver of additional gas burn in Europe these days is of course Turkey, which I think accounted for about half of the incremental gas power demand. And in Turkey, I think that it is important to highlight that one of the reasons is the low hydro availability, which has been down by almost 30% year on year. And now it is mainly the gas-fired power plants which are doing the heavy lifting. And of course, this also supports some of the pipeline imports recovery of Turkey, in contrast with 2020. So I think that altogether it is a combination of better conditions, like the low hydro and also the low wind in certain parts of Europe. But of course, the EU ETS, the carbon price is also providing some additional support to gas-fired power plants vis-a-vis coal generation, for instance. Thank you.
Well, thank you very much. The next question is I guess, is in part invoked by Luca's introduction. It's specific on the decline of flexible production in the UK and the Netherlands, which is ongoing. And so will Northwest European gas buyers need to reevaluate whether they should rely mainly on spot and short-term LNG procurement and look to enter or look to enter into long-term contracts with more guarantee of delivery? Which is a discussion I think we've been having in the Netherlands, at least for a while. So I'm especially interested to hear this answer.
Well, again, happy to take the first try at it. Well, if we're looking at the recent evolution, of course, there's the depletion in the North Sea, especially in the UK, and also the phasing out of Groningen in the Netherlands. It's not only a question of volume, which is disappearing. It's also a great provider of flexibility to the Northwest European market that has also been taken away gradually. Norway is also providing a lot of flexibility, but we've seen that in the past years, this flexibility is moving more to the British side and less to the continent. So it leaves the Northwest European market mainly with imported sources of flexibility rather than domestic sources of flexibility. Of course, excluding the pivotal role that is played by storage. But as you mentioned, Kobe, in the case of the Netherlands, the impacts of the magnitude of the flexibility conveyed by Groningen will not be replaced by domestic storage only. If we look at the next years, in what we say on a medium term, the next 3 to 5 years, the main midstreamers which are active in the area still have a portfolio of contracts, long-term contracts that span beyond 2030 to the main markets in Italy, Benelux, France, Germany. UK is of course a specific case, but in continental Europe, there's still a sizable amount of long-term pipeline contracts plus long-term LNG contracts that they have in their portfolio that can be routed to the European market. The flexibility that comes from the TTF and other Northwest European market is very important, but is of course also resulting from the multiplicity of different sources of supply, including the domestic supply, and providing flexibility. So we do expect that in the next years, as this flexibility is to be replaced by important flexibility, providers will need to source it. When you look currently at the structure of those big portfolio players, they're still structurally long. They have bought more capacity, especially on LNG. They have bought more capacity from projects which are still under development than the capacity that they have sold, which doesn't mean that this capacity will come to Europe. There's still, at least on the books, enough capacity to replace from the LNG, plus eventual contractual flexibility coming from the pipelines. But to answer the question by another question, it's also a chicken and egg issue on how quickly gas demand is expected to be declining in Europe with the strong measures that have been taken by the EU in terms of reducing its carbon emissions. So I guess that in the next 5 to 10 years, we will be in a pivotal situation in between guaranteeing both security in terms of volumes, but also guaranteeing security in terms of flexibility, especially during the winter and peak seasons.
Thank you very much for that explanation. It's very, very useful that the way you answered that question. Another question is about storage capacities in Asia. How fast and how much of storage capacity is being added in Asia at the moment?
Okay, do you want to take this one? It's one
yes.
of the topics you've looked at in detail.
Sure. So when we are looking at global storage development, we see that it will continue to increase in the next 5 years. So we have been looking at, until 2026, because typically 5 years is a good lead time for developing new storage sites. So, and what we see is that almost half of the additional storage capacity additions will occur actually in Asia, driven by China, where we still see a robust growth in residential and commercial demand. And of course, it needs, so this transforms into a seasonal demand pattern, which then needs to be met with underground storage capacity. Now, we are still talking at the moment in China about 13 BCM of storage capability. Just in comparison, in the EU, we have just 100 BCM. So, and in our outlook, this capacity is going to increase by 17 BCM, so it will more than double. Having said that, that it is still not going to increase as rapidly as the demand in China. So we still see that there is a lot of additional needs to develop other flexibility sources to support the development of the Chinese gas market. Thank you.
Thank you very much, Gergely. On that note, what do you think is the outlook for volatility and seasonality? Because there is negative winter-summer spreads in Europe, which might be a very specific type of situation. But if I combine that with the answer you just gave, is that if we well, we have the question for Europe on the one hand, but on the other hand, is there enough flexibility in the coming years in the international gas market to handle the sort of events like weather related or otherwise that makes the swings in changes somewhat more dramatic than we've seen in the past?
Well, we do not forecast prices. I think it's already a difficult business to do so, but I guess that forecasting the weather is even more difficult to do. So to try to keep it to a short answer, the situation we're seeing today is a strong tension on the supply, among others, to refill the storage during the injection seasons, because they have been a great contributor over the past season to provide flexibility in Europe. Whereas we can't see what's going to happen in the next 6 months, but I assume that market expectation is an average winter. So it will really depend on if the market expectations are right or wrong. If we have an average or milder than expected, like 2 years ago, colder than expected, like the previous one. One thing that plays in the whole story, as you say, Kobe, is how the flexibility needs are increasing in the Asian markets, and particularly in China, as we see that the growth in China for gas is not driven by power generation. It's driven by industry on one end and by residential on the other end. So industry can be modulated during the winter, and we have seen in the past years that when there are some shortages, the Chinese authorities shut down industry to make sure that deliverability is sufficient. But the more China relies on gas for its heating needs, the more seasonality will rise, and some mitigation measures are being developed with more storage capacity. China is also increasing its domestic capability in terms of production. But of course, the global market will be more impacted by cold snaps as the role of temperature sensitive demand is increasing in China in the coming years.
Thank you. On the, I'm sure in part it's inspired by some of the remarks we made, but we haven't, with regard to the European situation in terms of flexibility and recent developments in the market, in how far does booking capacities in certain gas pipeline routes play a role as well? Of course, I'm referring here to the story that we've seen in the past 2 years on Nord Stream 2 and its completion, and the political storm around it, which seem to have subsided for the moment, and the booking of capacity through the Ukraine. So I know that you don't want to go into pricing, but maybe a little bit on whether it is constrained or whether the supply is managed because of as a result of this dispute, or whether there is other possibilities for the shortage in terms of what is the capacity of the Russian supply at the moment.
Well, we'll certainly not speculate into a potential strategy of some sellers during tense market situation. But if we focus on a couple of facts, first one is that I'm not familiar with the sensitive and confidential clauses of the different long-term contracts, but my understanding is that the contractual commitments have all been fulfilled so far. There's been no force majeure or anything declared in terms of supplying the European market with what is expected from the buyers, and nomination rights are up to the buyers. So I do expect that from whichever source it comes, the amounts that have been nominated by the midstreamers, ultimately the European buyers, have been met. One thing, though, that we have observed is that over the past years, Gazprom has been increasing its presence in the short-term markets with its electronic sales platform, and that it has recently moved its volumes to a year ahead. So it's not available in the short term to deliver additional spot markets. So my understanding is that Russia is focusing on its role as a long-term supplier under its long-term contracts commitments. At the same time, we do believe in terms of transit and transport capacity, there's sufficient capacity by pipeline and LNG to supply Europe.
Thank you. Thank you very much for that answer. We have a somewhat technical question on the percentage of hydrogen that can be blended into the European gas network system. Maybe I can help you a bit. I think it depends very much also on legislation per country, what is allowed legally. But maybe you can give us, I don't know whether you know, at least from the technical gas side, how far you can go.
I think that's perfectly true. There is a variety on blending limits across European member states, and I think that this will raise at some point a question of the interoperability of the networks if it is not solved at some point. But I think that there is also an important difference between the blending limits, the potential technical blending limits, when we are talking about polymer-based distribution pipeline systems, which, you know, I have seen studies which would show that it is possible to go up to 15 to 20, 30%, and the steel-based transmission pipeline systems, which, you know, have typically a lower tolerance range, maybe between 2 and 5%. But I think that there is still a lot of work to be done to understand what are those actual limits on the system, and here maybe just to differentiate that, in contrast with low carbon hydrogen, biomethane and synthetic natural gas does not have those kind of limitations, because it does not lead to the embrittlement of the pipeline system. I just would like, if I may, to add one point to our previous question. So as we are having this webinar, the TTF months ahead prices continue to climb, and probably not because what we are saying here, because of other reasons, but they reached 37 euro per megawatt hours, which is not something we have ever seen since the Dutch hub has been launched. It translates into close to $13 per MMBTU. And I think that there's a number of reasons why we have ended up with these historically high prices. I think that first, we already had a tightening of the market since the beginning of the year for many reasons, but one of them is this very cold spring temperatures. So I think that at the moment where we are now, the market became quite sensitive, and it reacts maybe to different things in a more visible way. And part of that is, of course, I think that we see a supplier behavior from a major supplier, which I think is very clear that it does not necessarily provide natural gas above its contractual limits. But this is, I think, only one part of the picture. I think that there is also a quite interesting interrelation between the carbon prices and European gas prices. There is a relatively strong correlation between ETS and TTF. And I think that many people have their own eyes on the 14th of July and the expected announcements by the European Commission on the sort of reforms or legislative proposals related to the functioning of the EU ETS. So I think that that's another contributing factor. And a third one, and maybe this is less sexy, but my understanding is that there is not so much wind these days in Europe. For several days, the share of wind in the electricity mix has been well below 10%. And of course, this provides additional upward pressure to gas prices. So it is just to say that there are many other factors which are contributing to that, not only those interesting discussions about pipelines, but of course, those are the most interesting ones. Thank you.
Thank you very much, Gergely, for this explanation, because I think you covered also some of the other questions that were related to that. So maybe we can then go through. There was one slide where you showed how demand was developing, and then you compared it to your sustainable development and your net zero scenario by 2050. And so, what are your thoughts on how future investments will go in order to close these gaps? Because there's this debate has been more in general on after the launch of the net zero report, but in particular with gas, since gas is the as we now see, it's very much related to wind and solar supplies. And fulfills a very important flexibility function in order to make our systems work. What are your expectations with regard to investments in gas?
Well, thanks for asking. This goes a bit beyond the scope of our analysis and this report, but I'll try to do my best to answer to it. The role of gas in the clean energy transition in the longer term, in view of a net zero target, is much more complex than the other fossil fuels to begin with. I think that again, if we take the net zero roadmap scenario approach, which is a policy-driven scenario aiming at matching this net zero emission objective in the next 30 years, the picture is quite simple for coal and oil. We have to reduce demand as much as possible, as quickly as possible. For gas, there are probably as many answers as there are many markets at different levels of maturity around the globe. Because in some places, like the European market or the North American market, where the use of gas is already well developed, and the potential for fuel switching has been already used, or most of it has been already used. The trend is, again, to reach that net zero objective, to switch as much as possible to renewables, including renewable gases, also to increase efficiency gains as much as possible. Whereas in other markets, and I'm thinking of African markets, Asian markets, where there are some low-hanging fruits in terms of displacing diesel and power generation or coal in different uses for industry purposes, there's still a strong quick win to switch to gas and to improve air quality and to reduce the emissions. The question is in the longer term. So it's a difficult one. Two elements to answer to this one. The first one is that switching to a net zero path doesn't mean that we'll get a no gas system by 2050. Gaseous fuels are expected to remain. It's not switching to 100% electricity system. We do assume in the net zero scenario that the share of gaseous fuels will remain more or less the same as we have it today in end user consumption. It's just that the supply of those gases is changing. We still have natural gas, but planning to abate it with CCUS as much as possible. Also contribution from hydrogen and biomethane to supplement the decline of natural gas. So this is the first thing. It's not, we need to have an all-fuel approach to ensure flexibility and security of the whole system. The second one is that the global curve to net zero encompasses multiple speeds. And when we look at the situation today in India or in China, for instance, again, it's not the same patterns of what we see in OECD countries. So for that regard, investments need to have to bear in mind that flexibility to switch to low carbon gases. So to have to be CCUS ready or be compliant to accept hydrogen feed gas and anything like that. So of course, this is navigating in a complex environment, but the philosophy of that scenario stems from the idea, what are we going to do if we want to meet that net zero objective by 2050? And again, gas is part of the answer, but with different speeds in different markets.
Thank you very much. And of course, in the short term, we see some, as you alluded to that, some switching back to coal, like in the United States. And that might also be possible in Asian markets if capacities are still available. So that will also change the discussion, is what I'm saying, that it's not just all switching to renewables, but in the short term also switching back to coal is also part of the equation. We have, let me see, because you answered quite a few questions. There's one which I think is interesting. It's on the numbers you presented today. Whether you think that a 3.6% growth of gas demand for 2021, whether it might be optimistic at the end of the year, because of, as I just mentioned, perhaps some gas to coal switching in the United States, but also because gas demand in Europe may be decreasing somewhere from middle of the month, although that depends very much on how the storages are being filled at the moment, how far they are, and also the impact of Asian gas prices on demand in Asia.
So the view we have for the time being on 2021 does not rely too much on the contribution of power generation in gas demand for this year. If I'm not mistaken, but you have the opportunity to look at it in more details in the report. I think that over 75% of the growth comes from industry and residential and commercial. So for industry, this is mainly driven to GDP growth, which is of course a source of uncertainty. When you look, for instance, the resurgence of COVID cases in India, it's a very strong component of the global GDP forecast. But this is only partly related to prices. When we look at the Chinese growth, for instance, again, it comes from sectors which are more or less protected from prices because there's a strong incentive by the government to use gas in the industry. Second component, residential and commercial, is related to temperatures. We have seen most of it already happening. So this is based on the assessment that we have over the past heating season. Of course, there's still some uncertainty for Q4 if we have a colder than expected or milder than expected. But I would say that we are more or less, so the impact from fuel switching and power generation is not strong driver. This being said, of course, if we have more switching back to gas later in the year, this will stack up to what we already expect. Now, in terms of the number itself, 3.6%, it's not a huge recovery. If we look, for instance, what happened 10 years ago after the financial crisis, we had a much stronger recovery. I think it was 8.5% in 2010. The situation, of course, was quite different because although very strong, it was only, so to speak, a financial and economic crisis, not a health crisis as we've had been through currently. First point. Second point, 10 years ago, the gas market environment was quite different, especially in Europe and the United States, where by the time it was the power generation, which was the main driver. So we had recovery, and on top of that, we had huge fuel switching, both in Europe and the United States, and that potential has been tapped already. So it is a bit different. It was a bit difficult to compare the two recoveries, but if we had to, this is not as big as we had seen 10 years ago.
And maybe also because the decline in demand under the pandemic was also less extreme than, for instance, in oil markets. So that might also be an explainer. I think I combined some questions, but there's one that's maybe interesting. Is in your scenarios you take into account current climate change policies of governments. Do you look at other factors than countries' climate policies for future demand?
Yeah, well, we do have scenarios which are only limited to the policies that have been already announced or enacted. The two scenarios that we have presented briefly in the presentation, the sustainable development scenario and the net zero to 2050 scenario, go beyond that. They take as a starting point the objective of reaching net zero either by 2050 in the net zero scenario, by 2070 in the sustainable development. And then they back calculate based on this objective how we get there. So it's looking beyond what is already being announced. So of course, for those scenarios, there's a lot more assumption than just stacking up the policies which has already been announced.
Yeah. I don't know, Luca, do you have a last question? Because I ran through all the questions. Unless there's a really pressing one among the participants, then I would like to invite you to quickly type it up.
I'm not sure if you've seen the last one on ESG. Perhaps it's a nice open question on whether ESG and financial sustainability requirements will impact on the economics of US gas projects.
Thank you. I didn't scroll that far. I thought I was at the end. Sorry.
Well, yes, this is something that of course is gaining strong and stronger importance. We see it both for the major oil and gas companies, but also for the independents. One thing in particular, I think that the question was, sorry, Luca, Yep. Okay, sorry. Yeah, the question was addressing the case of the US market in particular. Well, two things when it comes to the US market. Still, strongly driven by exploration and production, which is a bit different from what we see in our European markets. There have been some strong pledges made by the biggest independents. I don't know if you can still call them independents, but those big companies, listed companies, who have all taken strong pledges over the past month in terms of methane leakage control and also reducing their emissions from the patch, switching to electric drilling, reducing their diesel consumption and operations, and so on. So this is of course a strong impact. But at the same time, to be honest, one of the key messages that has been sent by those companies is financial discipline to maximize return, given the depressed environment that the industry has been going through last year. This is the first thing. Second thing is that due to the nature of the North American E&P industry, there's a lot of small players that are not listed companies that operate in the oil and gas patch, and which, of course, may be subject to further regulation on methane emission and CO2 regulation. But for the time being, they are not under the ESG-related wave of tightening measures.
Thank you. And we have a last question on if there is a kind of bearish event actually put some downward pressure on gas prices, for instance, by something to do with gas storage or high wind generation. So I think someone is looking for trying to wrap the head around the fact that maybe prices will not be at 37 for too long. So is there, I mean, I think you answered already that most of the temperatures we've seen this year have been calculated in because we're at the end, we were at the end of the second quarter, so we can assume that we had most. You answered already that, of course, we're not sure how the fourth quarter will go, if we have an early cold snap somewhere in Asia, the United States, or on the European continent, whether that will impact. But yeah, still, is there something else out there that we haven't discussed? I think I would like to translate the question.
Well, I guess it really stems to, in the short term, as usual, temperatures and availability of supply. Again, we're not likely to speculate on those events, but if there are further unplanned maintenance on the LNG supply chain, whereas we have further heat waves in Asia during the cooling season, we can see further tightening. On the other hand, if we have a rather wet summer, at the same time, the maintenance goes faster than expected, it can sort of loosen a bit from the situation we see today. But those, I would say, in the short run, and as usual, those are the two factors that I would track.
Absolutely, and I think it it takes some getting used to again, coming out of 2019, where markets were somewhat weak, and then last year where storages were already full before the storage season really started. So maybe we just have to get used to the fact that that the gas market has quite a lot of yes, both seasonal but also shorter term changes, impacting on it, and that we have to wrap our heads around it again. I think if there's no further questions or any comments, either by you, Jean-Baptiste, or Gergely, to add to this discussion, that I think we've come to the end of this event. I see that some people are being pressed to go by slowly seeing the numbers go of the participants, that people are being pressed to maybe think about what the report says. The report is available, I think, on the website completely, which includes the slides that you've shown, because one of the questions was whether they could get the PDF of the slides, but I think all the slides, as far as I could see, were part of the report. So maybe that is not necessary. But please mail us if we have to ask the IEA whether we could also provide a PDF of the slides in a few days. But then I think what we would like to do is thank you very, very much for your presentation, because we've been doing this now every quarter, and we've seen so many changes in terms of how to read the gas tea leaves, if you want, and we need a sort of guidance through the market, because we do live in so much strange times that we know that energy is very much economically driven, but we have a health crisis in the world that is impacting the various continents in various times. So we're really grateful that you are separating all these different influences and make us see through what is going on in the gas market. And yeah, I'm really grateful that you each time you're willing to explain what you see out there, what you've analyzed, and share that with us. So Jean-Baptiste and Gergely, thank you very, very much, and you're making us looking forward to the third quarter presentation. Because you have basically taken us on a journey this year that it is important for us to understand quarter by quarter what is going on. So yes, well, like I said, we're looking forward to the third quarter report and see how much of the things you said today and how we look forward, how we are slowly beginning to fill in the some of the uncertainties that are still left with regard to that. So thank you very, very much. Thank you very much, Luca and the Istituto Affari Internazionali for hosting us. And on that note, I think we should close our session. Thank you very much.